Thank you for coming this evening, and I'm very relieved that do not have to educate you, so thank you for that, Russ.
Yes,
so I will by no means educate you. I might sort of inform, possibly entertain and interest you for the next 20 minutes, but I certainly won't educate you. So, yes, so the Brunner Investment Trust, like the other portfolios that we manage, is an actively managed, bottom-up driven global equity portfolio. We tend to have active shares around about sort of 80 to 90%. And we do think that if you're going to be active, you've got to be active. You're being paid to be active. I have a team in London and Frankfurt who help me, but also we have analysts around the world, about 80 analysts in San Francisco, London, Frankfurt, Hong Kong and Tokyo, who are all looking at stocks and feeding into our process. So we've got a lot of resource there. Now, Russ has told you a lot about the world, and actually I agree with a lot of what he says. So I'm not going to spend too much time going over it all again, but we do think we're going to get lower returns going forward than we've had over the last few years. We've been through a period of very strong returns, particularly in sterling, because sterling's been so weak. But if you look over the last 5 years, I think we've had between sort of 7 and 8% global return a year, and in sterling terms, it's been in mid-teens. So, that's pretty decent, and we think that that's unlikely to be quite as good going forward. Increasing volatility because we're at such low levels at the moment. I mean, it can really only go up, which is Russ's point as well. Now, the active management does add value in global equity universe, and it is one area where there's still the median manager is adding value. And there are other areas, small cap, emerging as well. But in an area where obviously passive has gained hugely, there's still the median manager in global equities is adding value, and we're doing better than that. And that is because the global universe is very large, and so there's about 8,000 stocks which are bigger than 1 billion. And so there's a huge, great, potential out there, a lot of under-researched stocks. And the way that research is going as well, there's probably going to be more under-researched stocks. So that's a huge opportunity, and it means that you really should be able to add some value in there if you do it right. So where are we on structural view of markets? Still on balance, we think it's going to be positive just because of the amount of liquidity there. Less, going forward than there has been going backwards, but it's still there. Big challenge is this nominal growth, and that no disagreement there with what Russ said. It is very difficult to get, economies in the developed world really moving very fast, and so that we think is going to be the constraint on normal returns. On a cyclical view, yeah, I think there is potential for stimulus, but we're not very optimistic about it appearing very, very quickly or being anywhere near as large as markets were assuming. However, I do think that the main Trump, peak Trump was really about the 8th of December from the way that we look at it. So since then, the expectations have been coming down about what the real driver would be to growth in the US. And in fact, this year, it's been more about Europe and slightly better economic momentum in Europe, which has been coming through. As far as valuation, no disagreement. The US is definitely expensive. Outside the US, it's less clear. I think Europe is sort of median range against history. Emerging markets look relatively cheap. So there's definitely more potential outside the US than in. And so that overall leads us to want to have some exposure in equities, which is good because that's what I do. But we are definitely not expecting to get the sort of level that we had of returns. We talked about volatility. I won't go on too much about it, but we've had a period of increasing spikes of volatility over the last year, which have been down to these political surprises, but it's kept coming down. I think our understanding is that's really because the amount of liquidity is still there. So that keeps bringing the volatility back down again. Sectors offering a few more opportunities than countries. And that means there's a big dispersion between what's going on in the market. So in the last year, you've seen technology continuing to lead the field, and you've seen energy really lagging. And that's been a big dispersion. And a big dispersion there, I think it's something like 30% between those two sectors over the year. That's been bigger than you've seen in the regions. Now, obviously, it depends how you count regions and countries, and there's probably some countries up 300%. But in general, you've actually seen quite a good potential for added value through sectors. And stock correlations have come down again, and that's a good environment for stock picking. And this does correlate with the volatility to a large extent. And so as this has come down, it does give you some more opportunity to add value through stock picking. And this, it tends to be the case that it will just sort of, you have these big sort of spikes in volatility and spikes in correlation. Those would be quite good periods for actually doing some stock picking, because you're not being rewarded in the short term, but you will be rewarded in the long term for it. So it's a decent period. So some of our thoughts on some of the themes in the portfolio, in various themes of healthcare, connectivity, industrials. And this is really the way that we pick the stocks is very much bottom up, but they tend to, when you actually look at the portfolio, they tend to find themselves into various sort of themes and sectors. So that the way that we think about it is starting with the stocks. But healthcare is an interesting area, and there's certainly potential for both growth and income in the sector. And it's a sector where there was quite a lot of value last year before the election, as all of the concerns about Hillary. That is now, there's slightly less because it's started to perform as a sector, but still within it, we think there's plenty of opportunity. There's a lot of opportunity from the management of healthcare budgets, which is going to be still a feature in all of the developed world. And the managed care companies are the only way that is going to be done. And so a company like United Health, we think, has still got a very good run road, whatever happens with the Affordable Care Act. The other area, I think, is real innovation. And so companies which can really have a new, not a Me Too drug, something that's really going to change health outcomes. There's still quite a lot of these coming through the pipe. And I think what's going on in oncology at the moment is really a complete step change to the therapy that we've had since the 1960s. So there are opportunities there, and a company like Roche is definitely at the forefront of those. But the one that I've just talked about a little bit more is Celgene. And Celgene is a company which is in multiple myeloma. That's their big drug is Revlimid, and it is the market leader. So that is, they've got a growth path there, which is about mid-teens growth at top line for the next 4 or 5 years. But alongside that, they also have a really interesting pipeline that is both in oncology, but also then in Crohn's disease and multiple sclerosis. And that is about 12 new phase 3 drugs coming out over the next 3 years. And so all of those readouts to come. And that is really not priced into the shares at all. It's actually a relatively decent-looking valuation on this stock. Not at the sales level, but when you get to the earnings level, because it's a very profitable company, very cash-generative company, it is on mid-teens. That's not bad for a company which is growing at that sort of rate, with that sort of potential pipeline. So that's a nice company. We've done quite a lot of interesting work on grassroots with it as well, talking about the use of Revlimid, longer terms of care and in combination therapy. So it's quite an interesting company. The other areas, technology. I said technology has really kept going through all different market environments. But within technology, there's huge diversification that you can get of the more cyclical, the more growth areas. Internet penetration is still growing around the world. Smartphone penetration is probably pretty mature, but e-commerce is still growing in double digits. And we've got exposure through Tencent, who hasn't, frankly, but we have, and we've got consumer. Priceline is a big one I'll talk about in a minute, digital advertising, and then just general access, which is still happening. Priceline is actually coming out with its figures tonight, so it's probably unwise of me to be talking about it, because normally what happens when they have their figures is that they will say, we've had a fantastic quarter, but it might get a little bit more difficult going forward. They always say this, so they're bound to say it again. So the stock, which normally does well, then will come off about 4 or 5%, and I'm sure that's what's going to happen again. But they've still got a very good growth path, and this is Booking.com, which I'm sure most of you probably use. But there are still about 40% of the world are not using it, and so there's plenty of scope for for growth in this. And this is an area we've used sort of grassroots research as well, because when we've had sort of specific terrorist attacks in various areas, a lot of these stocks do sell off. And the evidence that we get on the ground is that any halt in travel over any of these events is very short-lived. It's Paris, we did an after that, and it's only weeks, possibly a month, before people just go back to their own plans again. So there's actually more stability in the trends here than you would necessarily think. And then the other area I think is very interesting at the moment is industrials, because industrials are becoming more technology-driven companies. And this is also slightly shifting the balance of technology, the drives of technology from US back towards Europe. And there are some very interesting things happening within some of the industrial companies. And it is because they are more software driven, but also they've got more sales and after service and the more control of data. So some of these companies are still valued as cyclical industrial companies, but they're actually turning into much more fast growth, higher quality companies. And the one that we've got in here is Amphenol, which does connectors, but has just bought a sensor business a few years ago. And their sensor business is very widely diversified in a number of different industries. And that is beginning to really drive that top line, but also to increase the quality of the business, because they are now involved in the collection and the management of data which is coming from these sensors. So that, I think, is becoming much more interesting. And not expensive share either, and a very, very good quality company. You can't possibly read this, but that's our portfolio, and you will have it with you. So if there's any stocks in here that you want to tell me we shouldn't be owning or things we should be owning, you can tell me later. The performance, I've been managing the overseas part of Brunner since 2005, and generated alpha all of that time, about 200 basis points a year. And then we always ran it as a UK and an overseas part. But last year, we merged it into one portfolio, so it is now one global portfolio. We've made it more overseas, so it's now got a benchmark 70% overseas and 30% UK. And the performance is above the benchmark over all of these periods. But it's got a sort of nice accelerating trend to it recently, which is good. Now, the interesting thing about this particular trust as well, which is a sort of nice little feature too, is that it's had these two debentures around its neck since the 1980s, which are very, very expensive. One has got a coupon 11.1%, the other one is 9.25%. But we are beginning to see the end of the tunnel on these. And one is maturing in January next year, and the other one is 5 years after that. Now, we have cash to be able to pay it off, so there's no impact on gearing. But obviously, we're not going to be borrowing at that sort of rate going forward. So this is giving us huge flexibility around both improving the earnings, but also about the financing of the trust going forward. And we also will be looking at the second debenture as well to see whether it makes sense to be redeeming that one too. So this is an interesting factor of this particular trust. And so it's good to be managing it at this point in time. And owning it, in fact, at this point in time. So, I'm probably early.
7 minutes.
I know. Well, actually, I'm generally too fast. But so just in summary, we think that the outlook for the markets is still on balance positive, but nowhere near as positive as it's been for the last few years. Therefore, you can't rely just on beta. You need to be active. In global, it does make sense to be active, which isn't often published, but it is. And within the global universe, there are plenty of opportunities for finding interesting companies which can deliver both growth and income, which in this trust is precisely what we're doing. So very nice to talk to you, and happy to answer questions when we're in the panel.